Today, we're going to analyze Amazon's stock and see whether right now is a good time to invest in the company for the long term. First, let's see if there's a good business behind the stock. Amazon's projected to grow its earnings 16% per year over the next 5 years, while the S&P 500 companies are expected to do 17% over that same period. 4 points for Amazon and 4 points for the S&P 500. Amazon has a slower growing business. When it comes to profit margins, Amazon gets 5% out of its business, while the S&P 500 gets 18% out of its 500 companies. 1 point for Amazon and 2 points for the market. Amazon gets less out of its business. I like companies that pay out a dividend. Dividends are the only thing separating a true investment from pure speculation. Amazon doesn't pay out a dividend, while an S&P 500 ETF pays a 1.3% dividend. 0 points for Amazon and 3 points for the S&P 500. Amazon pays no dividend. As it relates to the dividend, we want to know how much is being paid out to shareholders. Amazon has a payout ratio of 0%, while the S&P 500 is at 22%. 5 points for Amazon and 3 points for the market. Amazon is keeping all of its money to reinvest and grow. Cash and cash equivalent is a basic measure of cash available for payouts, reinvestments, and acquisitions. Amazon has $64 billion in cash available for those activities, while the companies that make up the S&P 500 have an average of $74 billion. 4 points for Amazon and 4 points for the S&P 500. This metric benefits larger companies since they often command a higher economic value. Effectiveness is basically when you add the returns on assets, equity, and invested capital. Amazon has an effectiveness of 32%, while the S&P 500 is at 58%. 2 points for Amazon and 3 points for the S&P 500. Amazon has a less effective business. How good is an investment if it never goes up? Looking at the past 10 years, Amazon has returned a compounded annual growth rate of 26%, while the S&P 500 has compounded at 12%. 5 points for Amazon and 4 points for the S&P 500. Amazon is a better performing stock over those 10 years. I look at the PE ratio as a measure of speculation. When it's high, there's more people speculating on the stock. Amazon has a PE of 61, while the S&P 500 is at 23. 1 point for Amazon and 3 points for the S&P 500. More investors are speculating on Amazon. The PEG ratio takes into account the expected growth with the PE ratio. A PEG ratio under 1 is what we want. Amazon has a PEG ratio of 3.8, while the S&P 500 is at 3.06. 0 points for Amazon and also 0 points for the market. Amazon is a worse value right now. The quick ratio tells us if the company can pay off its short-term obligations. A quick ratio over 1 means it easily can pay those obligations. Amazon has a quick ratio of 0.84, while the 500 companies of the S&P is at 1.68. 1 point for Amazon and 3 points for the S&P 500. Amazon is less likely to pay its short-term obligations relative to its debt. While many investors look for a higher 200-day simple moving average, I look for one that's lower because it means more value. Amazon has an SMA 200 of 23%, while the S&P 500 has an SMA 200 of 12.9%. 1 point for Amazon and 2 points for the market. Amazon's stock is higher than the market. Short float tells us how much are investors betting against the stock. Amazon is short 0.72%, while the S&P 500 is short 1.08%. 5 points for Amazon and 4 points for the S&P 500. Investors are betting more heavily against the market. The average Wall Street grade from a strong buy at 1 to a strong sell at rating at 5. Amazon has a rating of 1.21, while the S&P 500 has a rating of 1.68. 5 points for Amazon and 4 points for the market. Wall Street is more bullish on Amazon. This last metric is income divided by the number of employees. Amazon's employees each have a value of $19,000, while the average of the S&P 500 is $305,000. 1 point for Amazon and 4 points for the S&P 500. Amazon employees produce little value for the company. Adding everything together, Amazon has 35 points and the S&P 500 has 43 points. Divide each by the maximum of 70 points, Amazon has an average business with a grade of 50 points. Compare it with the S&P 500 at 61.4. The S&P 500 has a better business behind its stock. But of course, we can't forget about Amazon's fair price and whether it's the right time to buy the stock. I use a discounted cash flow model taking into account a 10% margin of safety. That translates into a fair price of $100 for Amazon, which is 43% below its current stock price. When we look at the table, we can see that Amazon's stock is expensive, giving us 0 points. So if you're only concerned about the stock, wait until it drops by a lot. Before we get to Amazon's final grade, join my Patreon and get access to every company I've analyzed so you can compare them between your favorite stocks. It's updated all the time. Go to patreon.com/growthshares or click on the link in the description. Finally, we can put everything together and get Amazon's final grade. With a business grade of 50 and a fair price grade of 0, Amazon has a final grade of 45. That means Amazon isn't a good long-term investment if you were to buy the stock right now. There's an average business here that has a very expensive stock. Wait until both improve considerably. So what are your thoughts? Are you going to invest in Amazon? If you do, invest wisely. And as always, take care of your money.